Good morning, everybody. Thank you for joining us on this Friday morning as we continue our fund focus series where we discuss unit trust funds, the composition thereof, how they are used in portfolios. And today we're going to be specifically talking about global funds and the diversification into the wider world of assets that's out there. We've seen America now has a new president, and nobody is really sure whether it's a good or a bad thing. The markets are initially loving it, and he's already indicated some strange things. He apparently is appointing a suspect guy to be the attorney general. And Elon Musk has got his fingers into some of the pies, and apparently had a discussion with Iran yesterday. So head of Department of Government Efficiency and Restructuring some departments will be his title for the next 18 months now. I'm not sure if having a prime minister in a country that doesn't have one is such a good thing, but the markets are definitely loving the fact that Trump's back in the White House, and it seems that expensive markets may get more expensive. There's a saying in the stock market that markets can remain irrational longer than you can stay solvent, and I think that can hold to be true here. There's a couple of ways in which we can utilize our discretionary allowances of 1 million, and then, of course, apply for an additional 10 million to invest offshore. And we do offer those facilities to our clients, and our clients specifically have access to the feeder funds on our list platform, where they can choose from a couple of global funds to invest in. But as I've said, we're going to be discussing the PSG Investment Management Global Flexible Feeder today, and on the panel talking to us is Adrian Pask. Dr. Adrian Pask is the CIO for PSG Investment Management. We're privileged to have Greg Hopkins, who is the Deputy CIO for PSG Asset Management. And then Sidwell Mashile, he's a Senior Fund Analyst, and he's going to be telling us about the composition of the fund. We've prepared one or two slides to show it to you. So I'm going to kick it off and say, Adrian, I would like to know from you, why do we invest offshore?
Morning, Cyril, and morning to the other panelists and the guys on the call. When it comes to offshore investing, I think the primary benefit is really to try and access other opportunities outside of South Africa. So although it's very possible to do well in South African assets, it's always useful to have more opportunity at your disposal. And obviously, by accessing global markets, you can not only access opportunities from a stock level, but also specific growing sectors or themes as they evolve around the globe. If you think about specific sectors like semiconductors, for example, or the big healthcare businesses, or those kind of things that aren't typically available in pure JSE listed entities. But beyond that, obviously, it introduces a very nice lever in terms of being able to diversify and manage a portfolio from a portfolio construction perspective, where you can arrange the portfolio, engineer the portfolio in such a way that you can essentially diversify and stabilize portfolio returns. So we all know what happens when there's a drama in South Africa and the rand blows out, and it tends to be a useful buffer as the currency depreciates. Then that obviously helps investors. So the offshore component then tends to do a bit better than the local component, for example. So there's all sorts of benefits in terms of that. And then also, I think you must also keep in mind that some investors might have some offshore liabilities. So in that case, it's better to try and match that with the offshore assets. So if you've got something that you need to finance offshore, but you're concerned about the volatility of the rand or what might happen to the rand, then you can invest offshore in advance of that liability coming up to maturity and having to pay for it, and then have a problem with wherever the exchange rate might be.
Thanks, Adrian. So Adrian was talking about the different currencies. Greg, what's the difference between the rand-based fund and the offshore currency fund?
Yeah, so typically a rand-based fund or a rand-based fund would be what we use the word domiciled. So they would be domiciled in South Africa, and it would be priced in rands. And typically these type of funds would invest in South African assets. A dollar-based fund would typically be domiciled outside South Africa, so its administration takes place outside South Africa. So, for instance, the PSG Global Flexible Fund will be domiciled in Malta, and it'll be priced in dollars, and it predominantly invests in markets outside South Africa in global markets.
Okay, and Greg, you manage the portfolios that form the underlying of that fund, and tell us about your philosophy around picking stocks. I mean, do you consider currency values, macroeconomic factors? How do you go about picking from that wide universe of stocks for your portfolio?
Yeah, thanks, Cyril. So we would see ourselves predominantly as what we call bottom-up investors. So we like to buy shares in companies, and just remember, and this is always just a very good adage, is that if you're buying a share, in a company that's listed on a stock exchange, you're effectively actually buying a piece of that business. And what we're trying to do is find above average quality businesses that are priced at below average prices, and we'd like to hold them over long periods of time. We are cognizant of the macro environment. One needs to be very cognizant of that. And we predominantly are, trying to try and understand the macro, sort of the macro trends in terms of the growth trends or the sovereign risk in a country, predominantly just to try and help us what we call with our client journey. We're trying to avoid these big macro events, which could actually, lead to permanent capital loss in the future. When we're actually thinking about this big universe, and it's an amazing universe that one can invest in when you start moving abroad, it can be very, very exciting, but it can actually be quite daunting as well. And we've got a very, very simple philosophy in terms of how we go about finding, these above average quality shares at below average prices. And we like to go and shop in areas which we call are generally uncrowded areas, where there's just less competition. There are fewer people actually looking in that area. A good analogy would be if you're going to buy a house and there's 20 people trying to buy that house, the chances of you finding a bargain are very, very low. In fact, there's a reasonably good chance that you can actually you'll pay an excessive price for that house. But if you're shopping in an area where there's just very few buyers and you could be the only one, and that person who's selling that house is not that concerned about the price of that house, and they actually want to get rid of it for various reasons in a hurry, the chances of you finding a bargain is very, very good. And particularly in the areas that we often shop in, the odds of finding these above average quality sort of companies at below average prices are very, very high.
So you then try and pick from the bottom up from all of these stocks to see if you can get some value into your portfolio that will in time outperform the houses that everybody else is buying.
That's right.
Yeah. So Greg highlighted the domiciled part of the funds being rand-based versus offshore-based. But Adrian, can you highlight for us the difference between a feeder and the actual offshore fund?
Well, essentially, it all starts with the host fund, so the offshore fund itself. So that's the one domiciled in Malta, for example, and that portfolio will then invest offshore wherever it sees opportunities. But what happened and the history behind it is for some investors, it's quite a cumbersome task to try and get money offshore, convert it into the right currency, and then access it through Malta and all the admin and work with Treasury and SARS that you need to get done to invest in that portfolio. So a structure called the feeder structure was set up to really make it a lot easier on the client. So essentially what happens is instead of the client then having to go to SARS and Treasury and do applications and all the necessary disclosures, you can invest in the feeder fund, and the feeder fund will then ultimately play a role of taking money offshore, doing the currency conversion, etc. And that just is an easier, more cost-effective structure of getting all that operational load done on behalf of the client.
Okay, so the feeder fund's far easier, but you can access the offshore fund if you manage to take money out of the country and then have some funds offshore. Adrian, so Greg blends these funds, or Greg creates this portfolio, and along with the other managers that you consider, you then take those funds and blend it into your fund of fund structure. What are the benefits of a fund of fund structure?
Well, I think similar to how Greg, for example, as I mentioned before, would benefit from a wider set of opportunities in markets. In our environment, it's exactly the same, where we have a wider opportunity set when we select managers from abroad. So we just are not just focused on South Africa. We've got a specific team that focuses their efforts on doing offshore manager research in an effort to try and find world-class managers for the portfolio. So just a wider opportunity set. And again, the diversification benefit comes through because there's just different styles, different ways of doing things. As Greg mentioned before, obviously this comes at potentially a higher risk as well, because the other side of opportunity and a wider opportunity set is that you can mess up your selection. So it's great that you've got more alternatives available, but you still need to make sure that you choose the right ones. And I think that's a really important point. So if you follow this fund of fund structure where there's a research team behind it that can access the opportunity, but also sift through the risk and try and reduce risk in terms of selecting the right managers, then that adds additional benefit. And I think in our case specifically, the business now manages just under 200 billion in assets under management. So that gives us good scale. Some of these offshore managers are quite substantial in size, and to feature on their radar as a big player where you can actually have some negotiating power when it comes to the fees that you pay, you need that scale to work to your advantage. So we can obviously go to them with a bigger book of assets and say, on behalf of our clients, what can you offer us in terms of a fee? Whereas if you have to go as a pure investor on your own, I doubt whether you will easily get even access or a conversation going with the international asset manager, and never mind getting around to negotiating fees with them. And then the other big benefit, and this applies to all fund of funds, is the switching between funds, because things do change. Composition of teams do change. So if there's changes in the asset management business, say for example a key fund manager leaves, and we think there's risk there, the performance is being challenged going forward, then we can easily make that change, and it won't trigger a capital gains tax event. Where typically, if you use loose standing portfolios and you want to make a change to your portfolio, that would trigger a tax event. So it's essentially seen as a rollover event where the tax liability moves over, and that then means that you obviously, the saving that you make there also then compounds, because that's money that hasn't leaked out of your portfolio over time, and that's still invested in the market for you and can still generate some returns for you. Where as soon as you pay the tax, then obviously that component, there's the immediate impact, but then also any potential growth that you would have had on it, that opportunity is also then gone.
Yeah, I think retail clients don't realize the drag that they create on portfolios by switching out of funds, because as you've rightly said, the compounding opportunity that you're losing out on by staying invested in the fund has a huge benefit, and that is a huge benefit of this fund of fund structure. You've spoken about the research analysts who do the work for the portfolio managers in showing them what they deem best assets to consider, and we've got Sidwell here, and I wanted to ask Sidwell, and he's also prepared a slide or two for us, so we bring the slides up. I want to ask Sidwell, everybody may not have been in the previous fund focus discussions that we've had. So I want you to highlight the process of selecting these fund managers' funds in the blend for us. And then I forgot to mention that as I'm listening to you guys, lots of questions popping up in my mind, and I realize that for the audience that's the case too. So I want to invite you guys as we go along to type your questions in the comment section, and then we'll deal with that afterwards, and we'll direct it at the clever men on the screen. So, Sidwell, if you'll highlight for us the process of selecting these fund managers, please.
Thank you, Sarel, and good morning to our viewers. So when we look at our investment philosophy that we follow, particularly for this fund of funds, to understand the basis for our decisions, it is important to understand the framework within which we make those decisions. So particularly with this fund's investment philosophy, we follow three core principles. One, we place return risk and value for money at the forefront of our manager selection decision. Two, we believe that the return, risk, and value for money cogs, all three of them are incredibly important. And the third one is that we believe that all three cogs should complement each other and should not be viewed in isolation. Now, to implement these principles, we follow a split funding approach, which essentially involves spreading the bet. And this is under the belief that all managers go through periods, particularly over the short term, of both out and underperformance. And ultimately, we do this with the result in mind of trying to build a portfolio that over time delivers consistently above average returns for our clients at below average risk and for a competitive fee. Can we move on to the next slide, please? Now, in order to look at this from a practical level, what you see in front of you is the composition of the global flexible solution. At a practical level, how we implemented this split funding approach is by blending portfolios which consist of different return profiles. And this is in mind with what I mentioned earlier, that over the short term, different fund managers may underperform, but over the long term, we aim to pick managers which will outperform through the cycle. It is also important to understand that for the global flexible solution, the minimum recommended investment horizon is 7 years. So we hope that our clients stay invested for that entire period in order to realize the full benefit of investing in the solution. Now, back to practicalities. One, we look at identifying skilled managers, which we believe that we have based on the list of managers that we currently have on the screen. And then step two is to identify the manager's return profile and their potential role within the fund of funds. Now, the view that we will have on these managers, particularly when it comes to their return profile, is based on both quantitative and qualitative assessments. So, for example, we will look at things like investment style. We would look at whether or not a manager is a value manager or a growth manager or a quality manager. And we will also look at whether or not that manager is more aggressively positioned or defensively positioned. And then we will take all of that into consideration to ensure that over the short term, whenever, for example, the aggressive manager underperforms, there is a defensive manager in the solution that can provide support and vice versa. Now, it is also important for our clients to understand that aggressive managers tend to have those higher allocations to growth stocks and growth assets in general. And usually they will also have a higher portfolio concentration, basically meaning that their portfolios will tend to be punchy. And these are managers that will tend to outperform in bull markets. Defensive managers, on the other hand, those will tend to generally provide more downside protection, particularly in flat and choppy markets. And those will tend to outperform in flat and bear markets. Can we move on to the next slide? Now, once we have blended those managers that I spoke to in the last slide, what you then have is a global flexible solution in front of you that is essentially diversified across both asset classes and geographies. So, for example, if we look at the global flexible, the PSG Global Flexible Fund, which is an underlying fund in our global flexible solution, their equity allocations to energy, financials, and basic material stocks are amongst the highest compared to other managers that we use in the solution. Geographically, their allocations to emerging markets and the UK are also amongst the largest in the solution. Now, what this does is that it provides us with exposure to areas of the global opportunity set that other managers that we use in our portfolio might not necessarily be looking at. And this enables us to diversify the return drivers of our portfolio. We do this looking to position our portfolio to generate competitive returns over that recommended investment holding period of 7 years. And the end result is what you see in front of you, a solution which over that period will aim to outperform the average sector peer at below average risk. Thank you.
Geez, that was interesting. I really like that table that showed the different managers there and ranked according to value and core and whether bull markets work best for them. So obviously, this is a very well thought through process that you guys apply. And I had a look at the fund fact sheet. And the fund fact sheet shows that the top 10 equity holdings is stuff like Alphabet, Amazon, Microsoft, Samsung, Nvidia, Anheuser-Busch, and so on. But I was wondering, Greg, seeing that you guys are value investors, and obviously you use this to create some kind of a core for the portfolio, do you also look at smaller stocks outside of this to try and generate more alpha for the client?
Yeah, so we will invest across a range of what we call market capitalizations. We have found more value at the moment in the areas of, sort of the, let's call it on the smaller end of the market cap spectrum. But it's interesting when you think about it through the global lens. The median or average market cap in our global flexible fund is around $35-40 billion. These are still quite large companies, but when you compare them to some of the very large mega companies that be seen as being a bit smaller in comparison. We do have some quite large companies in the funds. You mentioned Anheuser-Busch. It's one of the companies we do own, alongside Asahi, which I think is in the top 10 of this on the global on the fact sheet. These are two global brewers, fantastic beer companies. There's a lot of focus in the moment at the moment in terms of investors are focusing on US technology shares, and they're leaving a lot of other shares off the radar screen. And those two companies would be very good examples of high quality companies, above average quality companies trading at below average multiples. And if we look across some of the other companies that we would own, we do have companies outside the US. So in the UK particularly, in fact, the UK is our largest geographical exposure in the global flexible fund. Some fantastic companies in the UK, and once again, this is a neglected market. A lot of investors just aren't looking in this space, preferring to look predominantly in the US.
Do you think the Brexit had something to do with the fact that the UK stocks are being neglected?
Absolutely. The UK has been through a very tough period. They've had some political issues. What was historically quite a stable political environment has seen quite a lot of change, and quite some concerns around some of the political management. Brexit was definitely quite a large overhang on that market, and we have seen a lot of local investors in the UK. In the UK, the markets are quite similar to South Africa in certain regards, where they've relaxed, regulatory requirements and the like over the last 20 years. And a lot of investors have taken their money. This is the UK investors have taken their money offshore and found better opportunities offshore. And what has created is an environment, fertile, where there's lots of bargains, where people are just not looking.
Great, thank you, Greg. Now you mentioned the politics there, and we've just finished our elections earlier this year, and the rand has been going quite strong until Mr. Trump entered the White House and the dollar became stronger again. But I think the view was that the rand was going to get stronger as the interest rates get cut and so on. And I wanted to direct this question at Adrian to say that, Adrian, do you think that now is a good time to take money offshore?
Look, I think what we've seen in the preceding 10 years have just been fantastic in terms of South Africans investing offshore. So obviously we've seen a lot of depreciation in the currency, which is over time an important component in the total return of offshore investing. But at the same time, US assets in particular, as we've mentioned, have done really, really well. and most investors would have benefited through that process. I think the next 10 years are likely to be a bit more challenging. Valuations as a starting point are quite a bit higher. The dollar is quite a lot stronger. So I wouldn't necessarily extrapolate what we've seen over the last 10 years. But that being said, if you can find the right manager that's cognizant of these challenges and risks and can steer a portfolio and position it into an area where there's still opportunity. So in Greg's case, he's now mentioned steering out of the US into the UK, where the markets are still attractively priced and there are underappreciated opportunities. That's really what we're looking for when we invest in offshore. So I think in some cases, I think managers will struggle if they continue to focus on a very narrow lane. So if you're just focusing on US large caps, for example, I think it might be a bit challenging. But I think that also quite nicely explains the value of diversity amongst our portfolio managers in our portfolios, that they can access some of these opportunities and pivot the portfolio into areas that offer better value.
Great, thank you. I'm going to pop over to the audience questions now. Let's go see if there are questions from the audience, and I want to invite you to quickly type them in the comment section, and we'll deal with them. We'll get to ask these guys their opinion of it. And I see Selvin has posted a question for us there. It says, is it a good strategy to have a local bank account saving in US dollars? And I think I'll take that one. It's quite simple. I think saving in a local bank account may get you an interest return, which is taxable, A, and B, it would depend. If it's dollar based, then you obviously are thinking that the excess return that you want to generate will come from the depreciation in the currency itself. So I personally wouldn't save in a bank account. I would rather save in capital assets where the tax rate's lower than my marginal tax rate, and simple as that. Selvin, I hope that answers. Let's see what else is there. Whilst the guys are typing away, let's see. Adrian, I was wondering when I looked at the fact sheet, and this was for the global fund, the offshore one, the dollar-based fund. How do I interpret that return on the fact sheet? Is it a dollar return?
That would be a dollar return. So that's an important distinction between the feeder and the US dollar denominated fund. So in the US dollar one, obviously you wouldn't have any rand depreciation in that performance number. It would purely be the weighted average performance of the stocks or other securities that you're using in that portfolio. And then obviously if the client brings that money back, the rand depreciation, if applicable, would be added on top. But if you use the feeder structure, for example, because that process happens within fund, the taking the money offshore, that any depreciation in the rand would be added on top of the performance number. It's also important to note that there's actually a very interesting tax situation there as well. So because the rand depreciation is included in the feeder fund's move, so either up or down, it's seen as capital in nature, otherwise included in your capital gains tax liability as your portfolio grows. But when you take money offshore, the capital gains tax component only applies to what you've done with the dollar, and the foreign exchange process, or the process whereby you took money offshore, is seen separate in the eyes of SARS, and they tax that differently. So that's also just another thing to keep in mind, and that's why we say this feeder structure makes it quite a bit simpler from that perspective as well in terms of reporting, because as you invest in the feeder, you get your normal certificate and you're done with it. Where on the dollar side, it does add a little bit of extra accounting work and disclosure work for SARS purposes.
So we can invest in the feeder fund, the Global Flex feeder fund of funds, or we can invest directly into Greg's funds if we choose to blend our own portfolios, as some clients of ours do. But your take is that staying with the feeder funds is maybe the easier and simpler option than trying to convert and taking assets into a dollar-based fund?
I think it all depends on the client specific situation. So maybe you've got a background in accounting, or maybe you have someone in the family that's okay with that kind of thing. But if it's something that's daunting for you, and you would like to use the services that's provided within the feeder structure, then I think it makes for a nice and tidy solution that's quite hassle-free, very easy on the platform. In terms of business processing, it's exactly the same as investing in any other local fund. So there's really no additional load required relative to those local funds. In the eyes of SARS and operationally, they are effectively local funds because they're denominated in rands.
Yeah, so Sid's touched on the 7 years recommended investment period, because effectively this is an equity fund with lots of equity exposure. What are the equity limits on your fund, Greg, being a flexible fund?
They actually aren't. So the flexible fund mandate is actually one of the most, well, it is our most flexible mandate. We can actually invest in a range of securities, and we can go to 0 in equities or 100% in equities, depending on the opportunity set that we're finding. And that flexibility is something that is we do think it's a nice additive to the fund mandate. And we have historically seen this as one type of vehicle, which is almost like a one-stop shop when you're investing offshore. If equity markets are high or we're finding few opportunities, we all have quite high cash balances. And if there are lots of opportunities around, which Adrian mentioned earlier in the markets around the world, and we're finding good opportunities, our cash levels will actually come down quite a bit. So that flexibility does allow us to actually just, to go where we think the best ideas are, or to be more cautious when we're finding a few opportunities.
Thank you, Greg. I see here's a question from Lebohang. Lebohang says, given the global impact that the fund has and extensive research is constantly done on the funds, how important is it that clients know the impact of the fundamental analysis and to trust the manager's active strategy to manage the fund? Lebohang, I think the easy answer here is, if you stick to the big managers, I mean, guys like Greg and them spend their days looking at research, deciding on which stocks to invest in and so on. And then on Adrian's side, a guy like Sidwell would sit and sift through tons of research to determine which fund manager to use. So I would say it's best to just pick one of the bigger brands. We know that there's extensive research on Greg's side with PSG Asset Management, and also on Adrian's side at PSG Investment Management. So you pick a trusted manager, those that deliver consistent top quartile performance, and you sit. I don't think it's necessary for the client to understand the individual fundamental analysis that was done in order to construct this portfolio, other than just trusting your fund manager to take care of your money. There are some people who are more interested in the research component of things, and they typically tend to do their own blends. But for the bulk of the clients, it's far easier to rely on someone like Adrian or Greg to manage the fund for them, and to simply align their objective to the objective of that unit trust fund, and then sit out the period to see how close we can get to that objective or goal that we're chasing. I see a thumbs up there, so I think I've answered her question. Selwyn's question was thumbs up there. I don't see any other questions. Any last of the lasts? Anything you guys want to add? Greg, Adrian?
There's some. So if we, well, just for one thing, I'll actually vote for Adrian's process. They do spend a lot of time doing the due diligence on us as a manager. So they're really trying to understand what we do and how we do it, and they check in regularly to make sure that we're doing it as we suggested that we would be doing it. So which is really important from a process perspective. Just maybe just from my side, when you're looking, thinking about the opportunity set abroad, and we've talked about an opportunity set, and which we are quite excited about, and maybe I can just give one or two more examples just to pique the interest. We talked about in the UK, the company reported yesterday, which is called Babcock. The stock was actually up, 5% on the day. It actually, what the company does is it actually builds and services the entire nuclear submarine fleet for the for Her Majesty's government in the UK. It also builds warships and it services military vehicles. And where we're looking out and over the next 10 years, we've got a sense that geopolitical risk, particularly when you have new presidents like Donald Trump in the hot seat, we think geopolitical risk was probably going to rise, not fall in the future. And if we look at this type of business, it trades on about 10 times earnings, so price earnings ratio, which is around 10 times earnings. Now, the average company price earnings ratio is around 20 times. It's amazing. So this trades at half the price earnings ratio of the average company. And we think this company is at least as good as or even better than the average company. And its growth profile, when we look out over the next 3 to 5 years, we think there's very, very exciting growth opportunities, particularly as particularly the European companies are spending more and more on defense spending, given these geopolitical risks. So that would be a very good example of this above average quality, below average price in a market that in an area where the market just isn't focusing. And there are other opportunities in energy, in global energy, particularly in emerging markets. The world is short energy, and there's some high quality companies that are also just off the radar screen at the moment when everyone's focusing on buying technology companies. So if you do your homework, if you go out there, just maybe one last example, Sarel, we do see opportunities, for instance, at the moment in Brazil. Myself and two of my colleagues are going out there next week to Brazil. We see it as a general, it's a very large country. There's over 200 million people who live in Brazil. It's also off the radar screen. There's people's concerns about some of the macro environment around the emerging markets. But to myself and to my colleagues, we're going to go out there. We're going to meet companies, speak to some economists, meet some government officials, do some site visits, kick the tires, and we're hoping to come back with some more opportunities for our fund.
Thanks for explaining that. That was really interesting. It's always for us as retail clients, it's interesting to get into the mind of the manager and see what you guys think about. I go to Brazil for different reasons. I mean, I go to South America for the meat, but you guys actually go there to go find opportunities, which is great. And then saying that, you triggered a question from Gerard that said, what's your view on India as a future growth market, Greg?
So it's actually been quite remarkable. So I've been investing 25, 30 years. I spent some time in London, 10 years in London. And it's interesting just watching the evolution of India over the years. Once again, a market that was out of favor. There were lots of concerns, and everyone was comparing India to China, and everyone saw China as this amazing country, very organized. Spent a lot of money on infrastructure, manufacturing a lot of stuff, and that was generally the more favored market. And India was kind of left behind. It seems to reverse now, and India now is the darling of the emerging market universe. Everyone seems to be investing in India. It's become very highly priced. The future growth prospects look pretty good, but you're paying a very high multiple and a very high price for those future expectations. And we would be doing probably the opposite now. We'd be actually looking at China as an investment opportunity rather than India, where, once again, I think there are lots of concerns around China. Lots of very high quality companies in China that are actually very, very cheaply priced. So there's a good fundamental thesis behind India, and there could be some good opportunities in India. But just as a market, we do feel that those expectations are quite high. And we use that analogy of that house. There are lots of people trying to buy houses in India, not so many people trying to buy houses in China, and that's the area that we would rather be focusing on.
Thank you very much, Greg. Adrian, any last comments from you?
No, I think with these offshore portfolios, I think people tend to forget how this area of the market has evolved, in particular over the last 10 years or so. I mean, it's been interesting to watch this. Since the early 2000s, there was a period where, after the dot-com, people weren't really interested in investing offshore at all. And then obviously over the last 10 years, it's really accelerated. So it's going to be interesting what happens over the next 10 years. But I think it's a complicated environment at the moment. I mean, Greg has now mentioned in terms of what's happening in China and India, emerging markets, visit to Brazil. There's a lot of geopolitical risk around. There's a lot of valuation dispersion. There's a lot of new products. What we typically see is a lot more speculation globally. There's just through all the stimulus, a lot of threat in the system. So I think an actively managed solution where there's quite a lot of input going into, are you using the right funds? Are you using the right styles? Do the guys have the ability to diversify? Are they looking in the right areas? There's a lot of value in that. And I think, unfortunately, similar to the analogy that Greg used in terms of buying houses, I think, unfortunately, what we do see, and it's not that we're anti-passive, but we do think passive investing is, let's just say, overbought at the moment. And there are meaningful risks around that need to be managed properly. And we think there's very much a very strong value proposition for an actively managed fund and an actively managed fund-of-fund structure at the moment.
Thank you very much, Adrian. Sidwell, thanks
I'll just add to that risk profile. If if we're thinking out, we're looking at the current investment landscape, and Adrian mentioned this concept of risks. And I do think diversification is really, really important at the moment. There are some significant risks out there. We've talked about a lot of the opportunities, and we have mentioned some risks. But when we look out into particularly some of the larger developed markets, and the US is one, debt levels are very high, and there does seem to be quite a lot of complacency around around inflation and the role of inflation. Most people think that inflation is now dead. But if it comes back into the system with these very, very high debt levels, and with a president that, particularly in Mr. Trump, who does seem to be less concerned about, adding more debt to the system, these are areas that you've got to tread carefully. And there could be some volatility in the market, so things could be going up and down a bit. We're quite used to this, these beautifully upwardly sloping lines. And that's something that, just to echo in terms of what Adrian is suggesting around, holding the line, staying here for the long term. There could be volatility, having diversification, and knowing what you're investing in, and trusting the people that you actually are, giving your money to. And I guess that's something we've talked a lot about, that process. There are risks, there are opportunities, but you've got to manage that sort of fine line between trying to get those two right.
See, that's the benefit of going to a professional fund manager to manage your money, and then those fund managers diversify into different assets, as you've explained to us, and then Adrian takes a blend of philosophies and diversifies that even further. So it's really no need for the client to consider all these different options out there. Just a comment from my side on Trump, and I mean, everybody says he's going to lower taxes, and you mentioned inflation. If he lowers taxes, it means companies that have lower financing costs, they may potentially pay more dividends or higher salaries, which will be inflationary again. So it'll probably be short-lived. And I think your statement about the volatility in the US is absolutely correct. I don't see any further questions on the comment section, so I wanted to thank you guys. Sidwell, thanks for the research that you do to enable these guys to create decent portfolios for us. And to Adrian and Greg, thank you very much for sharing your wisdom and your insights with us. It's been uplifting to understand how you guys think about these portfolios. And to the clients out there, thank you for attending these Fund Focus webinars of ours. We'll be back late in January. We're still to decide on the topic there, but we'll let you know, and we'll definitely be back with our panel of experts and an outside fund manager to talk to us about how they're thinking. We wish you all the best for the festive season, and have a fantastic Friday. Cheers, guys. Thanks for your time and insights.
Thanks
everybody. Keep well.
Thank you.
Bye-bye.
Cheers.